Pipestone Capital Corp. Unraveling the distinctions, forfeiting, factoring, discounting, and letter of credit. In the complex landscape of international trade and finance, various instruments play crucial roles in facilitating transactions and mitigating risks. Among these, forfeiting, factoring, discounting, and letter of credit are frequently utilized, each serving distinct purposes in the financial realm. Understanding the differences between these mechanisms is imperative for businesses engaging in global commerce. Forfeiting. Forfeiting is a method of trade finance that involves the sale of medium to long-term receivables, typically arising from the export of goods or services. In a forfeiting transaction, the forfeiter purchases the receivables at a discount from the exporter, providing immediate cash flow. The forfeiter assumes the credit risk, and the exporter is relieved of any future collection responsibilities. Factoring. Factoring is a short-term financing arrangement where a business sells its accounts receivable to a third party, known as a factor, at a discount. This provides the business with immediate funds, and the factor is responsible for collecting payments from the debtor. Factoring is often used to improve cash flow and transfer credit risk to the factor. Discounting. Discounting, in a financial context, refers to the process of obtaining funds by discounting a bill of exchange or promissory note. In this method, a financial institution provides funds upfront by purchasing the bill at a discount from its face value. The entity discounting the bill receives immediate cash but repays the full face value upon maturity. Letter of credit. A letter of credit, LC, is a financial document issued by a bank on behalf of a buyer, importer, to the seller, exporter. It guarantees that the seller will receive payment once the terms and conditions specified in the LC are fulfilled. The bank serves as an intermediary, reducing the risk for both parties involved in the transaction. Key differences. Nature of transaction. 1. Forfeiting and factoring primarily deal with receivables arising from the sale of goods or services. 2. Discounting involves obtaining immediate funds by selling financial instruments at a discount. 3. Letter of credit is a guarantee of payment in international trade transactions. Duration. 1. Forfeiting and factoring are often associated with medium to long-term and short-term transactions, respectively. 2. Discounting is generally a short-term financing method. 3. Letter of credit can be used for both short-term and long-term transactions. Risk allocation. 1. Forfeiting and factoring shift credit risk to the forfeiter and factor, respectively. 2. Discounting involves the sale of a financial instrument, and the risk depends on the creditworthiness of the entity discounting the instrument. 3. Letter of credit mitigates risk by involving the bank as an intermediary. Involvement of banks. 1. Forfeiting, factoring, and discounting can involve financial institutions, but the role of banks may vary. 2. Letter of credit is inherently a bank-issued instrument. In conclusion, while forfeiting, factoring, discounting, and letter of credit all contribute to the facilitation of trade and finance, Their distinctions lie in the nature of transactions, duration, risk allocation, and the role of banks. Businesses should carefully consider the specific needs of their transactions to choose the most suitable financial instrument for their international endeavors. Thanks for watching.